Let's turn to the advisory now and discuss how people can prepare for the proposed $3 million super tax, otherwise known as Division 296. Roger Perrett from Freshwater Wealth joins me now. Roger, great to see you. A very contentious issue. Let's just take a step back and talk us through Division 296.
I think it's probably not ideal for a lot of people, and there's a lot to consider. But I think one of the things that has probably come about a little bit is people who maybe not engaged with their super now go, wow, look at all these, probably like some of the wealthiest people in Australia are using super a lot. Maybe I should actually be focusing on it. Definitely the people who are closer to 3 million, they'll be definitely focusing on it. But certainly I think it's important for everyone to get more engaged with their super as a result of this.
And does Division 296 only affect those with close to 3 million? Because that's obviously quite a good problem to have.
Yeah, that's right. Like I think the immediate problem is definitely for those people nearing those balances. But I think the concern is with the $3 million tax that it's not indexed. So even though people may think, oh, don't worry, it doesn't affect me, I think over time and down the track it could well affect them. So I think it is going to capture a lot of people. And the reason being is the tax kicks in at 3 million, yet over time the contribution limits will go up with inflation, contributions from employer. If you have like a salary that goes up with inflation, so your contributions are going to go up as well. So I think over the course of sort of 5, 10, 20 years, people are going to be putting more and more into super, plus the compounding, yet the 3 million tax is going to be there as a ceiling and ready to tax people when they reach that level.
Yeah, I noted AMP put out a really interesting chart saying that even people in their mid-30s or 40s that are not necessarily on super high salaries, because as you say of the compound interest, if it's not indexed, then they could be in 20 years' time hit with that. So what's been the backlash, I guess?
Yeah, I think there's been a number of people, and in terms of social media and things like that, really highlighting the concerns. One is the $3 million cap, and the second one is the tax on unrealised capital gains. So you're sort of getting taxed on money that you don't have in a lot of cases. So, and that is a real concern, especially if you've got a lot of liquid assets. There's been concerns about a lot of people with fixed property, farms, or even growth assets, like people who have invested in assets which they're really hoping that grows in value over time, and they're going to be forced to potentially sell those assets earlier than they would have liked.
So are they some of the key risks, being forced to sell and of course this liquidity you're talking about?
Yeah, I think they're the main two. Yeah, absolutely. The liquidity and being forced to sell. The beauty of, creating wealth with growth assets is it compounds without having to pay tax, whereas now this is the first instance that we've seen where, no, not anymore. That compounding is going to be capped and limited based on this new tax.
What are the solutions then? What should investors be doing?
Yeah, I think the most important thing is to start early. That's definitely, especially if you're close to 3 million. But like you said in your example, if you're in your 30s and 40s and you're thinking long term, I'd definitely starting to consider it or get advice on it. So there's a number of things that we can do. So one is in terms of balance equalisation. So you can imagine if you're in a couple and one person has a really large balance getting closer to that 3 million or going to get to that 3 million faster than the other person, there's a number of strategies we can do there. If they're at the right age, we can potentially withdraw the money out of the higher balance and put it into the person with the smaller balance. So it's better to have two average balances, if I could demonstrate it that way, rather than having one really high balance and one much smaller. So that's one of many strategies we can.
Well, what about those without partners? The single tax, what are they doing? How do they invest differently?
Yeah, so just from an investment perspective, from a liquidity perspective, we can use potentially more Australian equities. So, and if we choose investments with a great or a larger volume of franking credits, those franking credits can then help with the liquidity issue, so people can then, fund that tax. But saying that, the tax doesn't have to be paid via super. So in some cases, people might go, I don't have the money, the liquidity within super, or I may not want to touch my super to pay the tax. You do have the option to pay it personally. You still got to pay the tax, unfortunately, but if you've got the money personally, you can pay the tax that way if you've got more liquidity in your own name compared to the liquidity in the super fund.
The Treasurer's kind of left it open to the fact that this could be changed by future governments down the track. Is that kind of kicking the can down the road somewhat?
Yeah, I think so. Look, the reason I don't sort of like that so much is because people like confidence. They like to know what the future is, not the, almost like the trust us type clause. And I think, what we really need is people to feel confident in the system that they're investing in. And I'd much prefer them if they, did give us some insight and say, well, it's not indexed for a number of years, but in 3 years it will be, or 5 years. But as you say, it's open to change down the track. And the tricky thing is, if we have more deficits down the track that need to be funded, is the government really going to be looking at that as a way to, ease the tax burden? I'm not quite sure. So it's probably not ideal.
And does it mean that people, particularly younger people, are getting disengaged with super? I mean, I read this really fascinating report that said instead of things like salary sacrifice, the younger generation are putting their money into alternative assets because they don't want to be hit by this either.
Yeah, it could well be the case. Like I haven't seen that. I think this is almost like a reason to get more engaged with it. And growth assets, especially in a low tax environment, like those alternative assets like you're talking about, is fantastic for super. Like the lower tax rates, it'll just help compound at a greater rate. But you've got to be across it. So yeah, these younger people, they either need to be across it themselves or get advice, I'd say. And
so as we end the financial year, what are some of the other tricks that we can do in terms of boosting super balances? Yeah, sure. So it's cutting it pretty fine because we've only got like a week or so, but certainly, there's a number of ways we can contribute to super. I think the easiest way to consider it is one where you don't get a tax deduction, and that you won't get a tax deduction up front, but it'll save you tax going forward. So that's if you've got savings, or you've sold a business or a property, or an inheritance, for example, you can contribute that to super. But then there's the other way where we do get a tax deduction. So on top of the employer contributions, you can put some last minute salary sacrifice or other contributions where you can claim a tax deduction. So there's the two, either claim a tax deduction or you don't. And you can go back 5 years, right? Yeah, you can if your balance is under 500,000. So for those younger people, you're right. Yeah, they may be able to take advantage of that, or people who maybe have had some time out of the workforce, with kids and things like that. That's an option as well.